Hello and welcome back. So, today in this session, what we will be doing is that we will be doing this particular question called Yilandwe, right? And then what do we have here is basically where is that Yilandwe? Yeah. So Yilandwe, whose currency is Yilandwe Rand, right? And then has faced some extremely difficult economic challenges in the past 25 years. Okay, so why am I even reading from there? Let's just read the requirement first. Nah? So discuss the possible benefits and drawbacks to Imami company of setting up its own assembly plant in Yilandwe compared to licensing for to undertake the assembly on its behalf. It's 5 marks. Benefits and drawbacks, right? So we have to talk about benefits and drawbacks. Okay, so the next part is about report, right? And then the report consists of what? Financial acceptability, that's always NPV, right? And then discuss the assumptions made in producing the estimate, right? So assumptions is there. Other is about business risks, right? Assumptions, business risks. And then reason, recommendation on whether or not, right? 3 marks. Should invest or not, right? Reason, recommendation. So in the conclusion we have to provide that as well. Okay, so it's very many things to cover, right? So let's see. Very long question. So Yilandwe has extreme difficult economic challenges in the past 25 years because of some questionable economic policies and political decisions made by its previous governments. Okay, questionable economic policies. So although Yilandwe's population is generally poor, its people are nevertheless well educated and ambitious. So that means they can hire better people locally, right? Just over 3 years ago, a new government took over the office, and then since then it has imposed a number of strict monetary and fiscal controls, including an annual corporation tax of 40%, in an attempt to bring Yilandwe out of its difficulties. As a result, the annual rate of inflation has fallen rapidly from 65% to 33%, right? So I'm already thinking over here, maybe they could just delay the project, right? Maybe after some couple of years, after the inflation basically starts to go down and everything, right? So I'm already thinking in that aspect as well. Maybe I could just write it down somewhere, So I'm already thinking about that as well, because of the given thing scenario where they say, because they basically said that, asked the question, that's why only I think. The drawbacks of setting up or like licensing, right? They talked about licensing just for that reason only, I believe so. Could argue it anyway, right? So, and then what is there? This strict fiscal and monetary and fiscal controls has made Yilandwe's government popular in the largest cities. However, there is seem to suffer disproportionately from the strict monetary and fiscal controls, which is rural areas, right? So that you could always write this thing in business regs. Yep. Another thing, right? Could just copy the whole thing, paste it, right, within the subheading business regs. And then it is expected that business regs the other regs, whatever the topic is, right? So it's expected that Yilandwe's annual inflation rate will fall in the following years as follows: 22, 14.7, and then 9.8, right? 3 year onwards. How many years profit are we going to, how many years of operations are we going to do? That's the important thing. Has decided to continue the progress made so far by encouraging FDI into the country. Okay. So recently government representatives held trade show internationally and offered business a number of concessions, including zero corporation tax payable in the first 2 years. So no taxes on the first 2 years. An opportunity to carry forward losses and write them off against future profits made after 2 years. Okay, so if there is a loss in the first 2 period, we can carry forward them, right? Okay, has made a promise. So the government representative also promised international communities investing in the Yilandwe's prime locations in towns and cities with good transport links. Made international companies investing in Yilandwe's prime locations in towns and cities with good transport links. So they have promised, right? So international companies investing in prime locations, right? So we have to look talk about this from a skepticism kind of thing as well. We could just be talking about that as well, how much money they have investable and all as well, right? So Imamco, right? Imamco, a large listed company in USA with the US dollar as its currency, manufactures high-tech domestic components for machinery, which is exports worldwide. After attending on the trade show, Imamco is considering setting up a plant in Yilandwe where parts will be sent and assembled into a specific type of component which is currently being assembled in the USA. It's a reference to Borat. Once assembled, the component will be exported directly to companies based in European Union. Okay, so it will be exported directly to companies based in European Union. So we will be getting the currency in euro. Okay, so we are getting the cash in euro, and then we will be, what's our local currency? YR. And then after that, we have to convert the currency to dollar, right? Because we are the parent company as well, right? So assembly plant in Yilandwe and other data projections are given over here. Before that, I just wanted to see if there are other headings or not, and then okay, seems like there is going to be some kind of opportunity cost kind of thing over here as well, right? Okay, let's look at it. Project will last for 4 years. The 4 year will require an investment of 21,000 million. So let's just write everything in million, right? 21,000 million. So 1800 of that will be 18,000 will be in machinery, 9,600 will be in working capital. Okay. So working capital will need to be increased annually at the start of each of the next 3 years by how much? Yilandwe's inflation rate. Okay, we will need some working for that, right? It is assumed that it will be released at the end of the project's life. So we just add everything up, right? And then it can be assumed, sorry about the noise, it's very noisy. It can be assumed that the assembly plant can be built very quickly and production started almost immediately, right? Assembly plant can be built very quickly and production started almost immediately. Okay, so basically that's again we are assuming, always okay, we found our assumptions. And then another thing is we can also write this thing in assumptions. I just remember this thing, the providing connectivity, right? Promised based on this assumption, based on those assumptions we've assumed. And then it's assumed the production will last for 4 years. So we've already got 3 assumptions right over here. So it could go on for longer, right? So this is because the basic facilities and infrastructure are already in place, as the plant will be built on premises and grounds of a school. The school is already ideally located near the highway and railway lines. Okay. Highway and railway lines, right? So is that even... and then the school will be relocated to other schools in the city. So the city will provide free buses to take the children to the schools for a period of 6 months. What about after then, right? Because let's say you've got a bunch of population living over here, you need a school over here, and then you're relocating that. At least you should build some school nearby or something. Otherwise, it's going to be a bit of a PR disaster, right, for the company. So we can write that in business risks. This is about business risks and its image right? We can talk about that. The current selling price of each component is euro, right? It's likely to increase from year one onwards. So from year one. So it's basically from year one itself only. The number of components to be sold each year are basically sales component units are given. The parts needed to assemble components in Yilandwe will be sent from this at a cost of this. Right, from Imamco would currently earn a pre-tax contribution of 640. Right, however, Imamco feels that it can negotiate with Yilandwe's government and increase the transfer price to this 280, right? 280. So basically it's making a contribution of 40 at the moment. If it is increasing it to 280, right? I mean, that's just going to increase it. 240. What am I even doing? It's basically going to increase by 80 only, na? So it's currently sending it at 200, on which it's making 40, right? On 200. So it's just going to cost them that much, right? So 280, it's increasing to that. Contribution is currently what? 240. So that's just going to be 160, right? So 280 minus 160, it's just going to be 120. That's what they will be making, right? Okay. So it's just going to cost them that much, right? In Yilandwe transfer price, right? Component cost. The variable cost to are currently this much. So this is in YR currency, right? So that amount, and then the current annual fixed are this much. All the costs incurred are expected to increase by the year's country's annual inflation every year from year one onwards, right? So it's within in the first year itself it's going to rise. We know the inflation rate, right? It's given up, remember. And then the corporation tax is 20% in the United States of America, and both Yilandwe are payable in the year the tax liability arises, in the year, not deferred or anything. Otherwise we would have to push it to the next year, right? So TAD is available 25% per year on straight line basis. That's easy then. Sorry. Project is for 4 years only, right? Right, and then what else? 25% per year. And Imamco will continue to expect annual royalties. Okay, they want some royalties as well, right? The normal royalty fee is currently 20 million, but feels it can negotiate this with the government and increase by 80%. So 20 into 1.8. This fee will not be subjected to any inflationary increases. So we are putting this in assumption as well, and putting this in the other risks as well, so that if some new government comes in, and also this could be because of the ruler dissatisfaction with the government, so they could basically give all these things away, right? So once agreed, the fee will not be subject to any inflationary increase. So okay, that's one thing we don't need to worry about, royalty, right? So this will have an impact on both the cash flow, huh? So we have the contribution component unit will be giving us some cash flow. Of course there will be some project cash flow as well from the Yilandwe, and then we'll have the component part of it, and then we have the royalty part of it, right? It will be subtracted from the up because it's a cost to the to Yilandwe based company, right? To us it's an income. So that is one thing. What else? Yilandwe. So if Imamco does decide to invest in assembly plant, it exports from USA to EU will fall and incur a redundancy cost. Okay, we need to add these things as well. After tax cash flow will reduce by the following amounts. Okay, so it's given. Okay, easy. So it's in three figures, 3,000s. Okay, we've not been given that. What is this figure in thousands or what? 20,000. Could be million. Could be 20 million or so. Normally uses cost of capital of 9% to assess new projects. However, the director feels the project specific discount rate is that much. Right. Okay. We will do so. What else? Current spot rate, euro per dollar. Euro, YR to euro. We will be using that at the beginning, but that is also increasing very. Where is that? It's revenue. Revenue component. Well, somewhere here. Yeah, it's going to increase, right? So we will be basically using what we have to. Okay, forecasted rates on expected interest rate differentials, right? There is a generic term on this thing as well, right? That can be told on assumptions and all, on limitations and all. Okay, so year per dollar is also given, YR per euro is also given. In the first year it's going to be this much, and then this thing. So we'll use this in terms of discounting the initial capital and all, right? So initial investment and all, right? So expected inflation rate, we will need this thing as well, because because we have to increase the price, that's why. For next 2 years is 5%, and then 3 years onward is this much. So 2 years is done, and then USNA is basically constant, 3%. Okay, easy. So let's see. What about the benefits and drawbacks of setting up its own assembly plant, right? So there will be greater risks, of course. Right, so what about the benefits of it? Basically, there will be some kind of future projects and all as well, right? So it will be risk diversification and everything. So as opposed to licensing, Yilandwe wants to attract and is willing to offer a number of financial concessions, right? So which will not be available to local companies. So the company will be able to control the quality of the components more easily. Yes, I forgot about this thing. It always happens, right? Control, and then they don't have to offer targeted training facilities if it has direct control, right? Can offer better and targeted training. The company also may be able to maintain the confidentiality of its products, right? To basically imitate and all. And then if international may provide risk diversification for the shareholders as well. Is it listed company or not? Is it listed? It's a listed company. Are not well diversified, and then even if they are diversified, they could not have invested in emerging markets and all, which could provide them additional diversification, right? It could provide new opportunities in the future, because there could be some follow-on options, right? Drawbacks will be of course, like it will require higher upfront cost, so utilize saved cost on other projects, right? So there will be some cultural issues and also which will be easy to mitigate, legal issues and all, right? So the licensee local may understand the operational aspects of it better. He'll be able to get off ground quicker. On the other hand, may have to become familiar with the local system and culture. And I wanted to add to this as well, like because of the well educated thing as well, we could do that. We could talk about that as well. Or what we could also talk about maybe is steeper learning curve from them, and then the country has a motivated and well educated workforce. That's one thing. Another thing I wanted to talk about was, like providing the licensing thing will basically uh, be easier for them not to expose themselves in terms of PR related thing, because of that school moving around and all, right? So relocation, Okay, on the report. So the report considers whether or not it would be beneficial for Imami to set up a assembly plant in Yilandwe, right? So considers whether or not. And then it takes accounts of the financial projections presented in our, discusses the assumptions made in arriving at the projections, discusses other non-financial other risks and issues, right? Non-financial which should be considered. The report concludes by giving a reasoned recommendation, right? Reasoned recommendation. And then the first heading is basically assumptions made. The second headings is risks and issues, right? And then what we have a recommendation. We would have basically have like a conclusion thing, right? But it's this. So we have to write from like not this format, but I preferably like to do to, from, date, subject, and all, right? So all these things. So let's see at the appendix. Let's go into that good stuff. So sales component. So sales revenue. Let's just go into the workings of it, right? Why not? Let's go into the workings. So basically it's what sales price is 700 times the inflation rate times the exchange rate, right? It is that. So but what we need, so it's like what, 700 euro, and then what we do, we basically multiply that with the inflation rate of euro. It was how much, given somewhere below 5%, right? 5% for the next 2 years. 5% into 1.05 into 1.05, right? And then what else? So all the sales price have been computed, and then the parts was how much? And then the parts and all the variable cost and all is there, right? And then all these costs, right, are expected to increase by the annual inflation rate, country's annual inflation rate, right? So we have the component parts of it, right? So the parts that will be included in it. Then we have the variable cost, which is in YR, right? So we have it 3 different currencies: euro, dollar, YR, right? All these are adjusted for inflation, yeah. So even this transfer price is adjusted for inflation, right? And then this thing is also adjusted for inflation, 15,002 or whatever the inflation rate is, right? So basically we are doing 150 multiply by your rate and then your exchange rate. Where do we have it? We have it given over here somewhere, YR2 per euro, right? So per euro, 1 euro is equivalent to 165, right? So that's giving us all those sales revenue. Parts cost is basically on the dollar thing, right? We've been given the exchange rate, just use that, that's easy. Variable cost, just unit times the rate only, right? Because we don't need to because it's in local currency, that's why I don't need to need any like exchange thing, right? So no need of exchange rate. That is good. So sales revenue and cost, that is been computed. So let's go put in the figures, plug in all these things. What about the fixed cost? What's happening with the fixed cost? Where is fixed cost? Fixed cost, is expected to be 4,600 times the inflation rate, right? So just don't need to do a working for it. A royalty fee minus, there is another expense on it, right? Royalty fee, it's going to be what, 20 million, and then times 1.8, right? Isn't it 80%, right? 1.8, so 36 million times the exchange rate. So we have to use different exchange rate for that thing as well. So 36 million times, that's in dollar, right? So dollar to YR 120.1, and then we have to use the other rate, and then for third year, for fourth year, and then we just compute all those things based on that. Royalty fee is there, right? And then TAD is there. TAD is computed based on what? It's computed based on the investment amount, not the investment amount, I mean for machinery only. So 18,000 divided by 4, 18,000 divided by 4, so that's in million, right? What about the sales revenue? We've computed that in million as well, isn't it? Because we've computed that in million. Yeah, in millions, right? Yeah, so everything has to be in millions. Okay, so fixed cost, I mean TAD, it's what, 18,000 divided by 4, right? So it's going to be what, 4,500. 16 and then 5 2, yeah, 18, yeah. So it's 4,500 million. So we just subtract that, we get our taxable profit or taxable loss, right? Remember, we have to calculate, we can show a thing as well, but we could just say tax losses carried forward, and then in the second year, in the first year and second year, we don't have any taxes because we have something, because it's a tax holiday for 2 years, right? And then we adjust the taxable profit with the TAD, that taxable losses that can be carried forward, and then based on that our profit is 40,000, and then based on that we subtract it, right? And then after that we add back the depreciation, and then on this thing we also add back the tax loss that's being carried forward, right? Hmm. Because that's a benefit to us, right? We just add it back. It's not a tax expense, right? And then other thing is, basically we just compute the 40% of it. I think in the United States is 20%, so we don't have to pay any additional taxes, isn't it? 20% in USA. So cash flow after tax is computed. Right. And then after that, what we could have just got done all this thing in a working as well, right? Could have saved that much space, but it's fine. Working capital is what? Working capital, where is that working capital? It must be somewhere here with the investment. I think working capital is going to increase, blah blah, 9,600 at the rate of inflation rate, right? So 9,600 multiplied by, so there will be some kind of working for it, but it's not required as well, right? So 9,600 times, and the inflation rate, whatever you get, 9,600 times something, and then the differential amount is this thing, and then you just contribute that, and then you just add it all up, and then you get 14,000, right? And then machinery is there, 39,000 is there, machinery and land and building, right, could be separated or not. Yeah. So cash flow in YR is this thing. Exchange rate, we just plug in the values and just worried about the exchange rate over here. YR to dollar is given, so that's the same rate over here, and then we just compute all these rates are already given. We just put in that, and then we get the remittable flows, and then within that we have to add some contribution as well, right? So because we are selling them some parts over here, so parts contribution was what, one, it was $40 at the beginning, so 40 plus 80, it will be 120 because we increased the price, right? So it's going to be 120 plus the inflation rate per unit, right? Per unit. So that's just going to be that for the year. Royalty is basically just the amount that we are charging. I think it's the constant 36 million, right? That's the constant amount, and then anything else, we have to pay some taxes on this thing as well because this thing is already taxed, right? We have to pay some tax on this thing as well. Could have just done into 0.8, but yeah, could be all right. Yeah. So taxes on that, and then we get our net cash flow. We discount it at 12% because the country risk profile is higher, the project risk profile is higher. We get a value of 148 before considering the impact of lost contribution and redundancy, right? So lost contribution is basically, lost contribution and redundancy could be 0.1 million. But the amounts are in, made that amounts are in dollar instead of dollar. Okay, we are not given any denomination, right? So anything will be given. Okay, good, easy. Right, what does it say? So assume that revenue, all this cost, everything, inflation figures, all are accurate, right? This is a generic statement that we can write, and then using sensitivity and scenario analysis may aid, right? So that's always the thing that should be remembered. So no additional tax is payable made during the first 2 years when the project will not pay tax. So it is assumed, yeah, no additional tax, because a holiday in one country means like you are not paying it in the other country as well. It's just assumed, yeah. No details are provided on what happens after the project ends, right? So what happens to the machinery and all. The project may last beyond 4 years, so it could yield some positive NPV. Additionally, even if the project ceases after 4 years, no details are given about the sale of land and building and all. So residual value of the thing could have a considerable bearing, right, on the outcome of the of the project. It is assumed that transfer price increases the contribution which Inomi earns from the transfer. This is probably not unreasonable assumption. However, it is also assumed that the negotiations with the government is successful to increase the transfer price and the royalty fee. Yeah, both of them. Yeah, this is also increasing. The other transfer price is also increasing, right? Needs to assess whether this is realistic or not. The basis for computation is not clear, and then the explanation is not given. So for 12%, a further investigation is needed. Although scenarios states that the project can almost start immediately, so we can talk about that time frame as well. It's assumed that the basically the exchange rate will reflect the differentials in interest rate between the respective countries. It is unlikely because many factors affect it, right? Move in line with interest rate differentials, right? The exchange rate will move with interest rate differential. That does not happen. So it could basically have a lot of political risks, right, as I stated. So it's not popular in rural areas, and then the population generally remain poor, right? So the government may change during the period. Now new government may renege or just take away, right, all these benefits given. So they just need to decide what happens, what to do if this happens, right? So I think needs to assess the likelihood that it will be allowed to increase the parts and then the royalty fee, because whilst there is opinion that currently Yilandwe is open to such suggestions, this may depend on the interest of the government, right? Which may get from other companies to invest in Yilandwe. It may consider that agreeing to such demands from Imoni may make it obligated to other companies, right? So they might consider, they might rethink it, because others might also seek the same concession, right? So the financial projections are prepared on the basis that positive cash flows from Yilandwe will be remitted back to USNA. Positive cash flow from remitted back needs to establish that this is indeed the case, is continue. So there is no remittance blockade or anything, right? Needs to be careful about the ethical stance and its values regarding the school and all, right? So just considering all those children, and then how 6 month, and then it might have a negative impact on the company, and then contrary to ethical values which the company could hold, right? Needs to take account of the cultural risks and all, right? Because there'll be employees and all, so it talks about culture. That, so this is about what fiscal and regulatory risks, right? So likelihood of changes in tax rate, laws and regulations, and then strategies to mitigate eventualities. So there could be some kind of delaying kind of thing, so that they can take maybe it's coming over here, they're talking about it. Should consider mitigate as far as possible operational risks, right? Such as the quality of components and maintenance of transport links. So they might provide the transport links, but it could not be maintained by the government, right? So they can't deliver on it because of lack of funds that could be there, or like just because of their workings it might be slow. Should assess and value alternative real options which it may have. For example, it may consider whether licensing the production of the components to a local company may be financially viable, right? It could consider alternative companies which may offer more benefits. It could consider the project be abandoned if the circumstances change. Against entry into Yilandwe may provide EMMU with other business opportunities, right? Should basically always talk about other exploring other opportunities as well, right? So that's always a generic statement kind of thing as well that we can always make. Some stance on it, right? And then recommendation. So the result from the financial projection, it's basically it should be accepted, right? And then it is recommended that the financial projection should be considered in conjunction with the assumptions, issues and the risks and implications of this before a final decision is made, right? There is a considerable scope for investigation, so they always talk about what scenario analysis and sensitivity analysis, that always should be there in the recommendation, right? Or in the conclusion. Alternative real options should be considered. A reasoned recommendation on whether or not, right? We have to provide a conclusion as well. Consideration must be given to the risks and thing, blah blah blah, as such as impact of ethical stance on the company, and then the impact on its of school affected is close to accommodate it, right? All this consideration should be there. And then we've told we need to accept the project, right? We basically at the first we tell we need to accept it, and then we give our recommendation. It should be only looked at in conjunction with all the assumptions and the issues and risks and everything as well, right? So however, there is always scope for further analysis, further investigation, and then that is basically should be accompanied or using different kind of tools or analysis techniques such as simulation, scenario analysis, sensitivity analysis, right? And then just talk about the ethical thing as well, right? Just generic. You see, in the assumption as well, there is something called generic statement right over here. This is generic, right? Basically, the exchange rate moves in line with the exchange rate differentials, right? And then that we can always talk about the cost of capital. Basically, normally they increase the cost of capital when they are investing in this kind of risky environment, right? So we could always talk about that. it is assumed that like all the risks are reflected within the cost of capital. We could talk about that, right? And then we could talk about all this thing is also generic because sales revenue, cost, royalties, investments, working capital, cost of capital, inflation figures are accurate, and there is uncertainty surrounding the accuracy of this, and then the small change could change the forecast of the project considerably. A number of projections using scenario analysis and sensitivity analysis could basically aid in the decision making process, right? Could always talk about that. Other thing could be, so the assumptions can be find out. You see, like it's assumed, and then it's assumed, right? So it can be. So all these assumptions are already given in the question as well. Just highlighting them, copying them down. It's really easy. Makes the job very easy. Yeah. So it's a 148 million. Of course, it should be accepted, right? Anything in peculiar? Anything in peculiar that I wanted to talk about was, yeah, this lost contribution and all, right? So that could have a bit of impact. Yeah, could have included. Right, that's happening. When is that happening? In all these years, so we could have just discounted it. No need to discounted it as well. Yeah, we could have just added it somewhere here, right? All this opportunity cost as well. So yeah, the remittance flows is there, then the contribution, and then royalty, and then we just have the tax. Okay, that's it for today. I'll see you in the next one. Take care. Bye bye.